And I know times like this you just take it slow. I fall asleep in the pillows. She got my heart in a chokehold. And there she goes.
Assalamu alaikum. Hello everyone. This is Liquidity Club by Ahmed Shawi. Today is Sunday, the 26th of November 2023. I'll be doing the weekly market review. So let's get started. Starting with DXY, as you can see last week, we have closed below the consequent encroachment of this discount wick, and we have formed a fair value gap. Now we have a fair value gap here, and we have the bearish order block. Price, before it takes out this low and reaches up to this wick consequent encroachment as drawn liquidity objectives that I'm looking for, it can retrace and work inside the weekly fair value gap and the bearish order block. So going to the daily chart, as you can see now we have a long wick here, long discount wick. If price closes on a daily time frame below this consequent encroachment, I'll be expecting price to never take out this high and never work inside the weekly fair value gap and or the bearish order block. So if we get a daily close, listen to me properly and listen to me carefully. What I'm saying here is not ambiguous. I'm calling out specific levels in price. It is not a zone. It is just a level. If I see price close below this level, which is the wick consequent of this discount wick, if I see price close below it on a daily time frame, I'll be expecting price to take out this low if it didn't take it so, and to reach upward this sell side liquidity and this wick consequent encroachment. At the same time, if that's gonna be the case, if it got respected by the wick consequent of this resistance, this means that it is just treating it as resistance and it will just continue going lower. Otherwise, if we treat the wick consequent encroachment as support, maybe we can wick and take this low, but the bodies has to close above the wick consequent encroachment of this discount wick. If that was the case, then we will probably see a retracement, take out the short-term high here, walk inside the fair value gap, bearish order block, and then continue running lower. So it would be forming an intermediate term high for the long term. So that's what I'm looking at in terms of DXY. Rewind the video and look exactly and listen carefully to what I'm mentioning. It's very specific levels. And as you can see here on the daily, we formed a fair value gap, price walked inside of it, internal, and then it is likely now to walk inside the external. But this will tell me if we close on Monday, we will see Monday how's Monday's trading. Do we close below this with consequent? If that was the case, and we took that this low, or if we didn't, I preferably want price to just close below it, but not take out this low. If we close below it and not take this low, Tuesday, I think it's just gonna be retracing a bit and then just jamming lower towards the sell side liquidity and the consequent encroachment. If we just on Monday we just wick through it, take out this low, and we close above it, this is telling me that we're likely to reach out for this high and work inside the fair value gap here, the weekly fair value gap, this fair value gap, and the bearish order block. So that's about DXY. Going to ES. Here we are viewing the continuous contract on the weekly time frame. As you can see, as of last week's trading, we formed a fair value gap here. Also, we have a small inefficiency here. But you can see that we have attacked the rejection block that I called out last week. So I mentioned that we can see price attacking the rejection block and not attacking the buy side liquidity, and that's exactly what we've seen. Price can I see the price is very close from the buy side liquidity. If it wants to accumulate more positions, it can accumulate positions at this area, the high of the weekly inverted fair value gap, and the basically the 25% level of the weekly fair value gap. This fair value gap here from this candle's high to this candle's low, as on a form of an institutional order flow entry drill before it continue running up higher, attacking the buy side liquidity right there. So that's what I'm expecting if it wants to retrace, although I'm wanting it to just run because it's very close to the buy side liquidity rather than retracing to the weekly fair value gap. If there is not much large funds stops above this high, it is going to retrace a bit, tricking them into selling that this is a resistance. They will be drawing lines here and they will think that this is resistance and price is going to be dropping lower, taking out the slope. While this is not the case, dropping lower, accumulating positions here as on a form of an institution or the front drill are going to build stops above this high by retail and large funds primarily, which we're later going to be attacking both of these. So because now they're looking like relative equal highs, price is going to be perhaps tricking or trapping retail or large funds by retracing a bit next week and then running up higher, attacking the buy side liquidity that has been engineered and aim for this buy side liquidity. Above that buy side liquidity, I'm going to be mentioning it next week. I'm going to be viewing the monthly chart more likely, and we're going to be discussing how it's going to be happening. So I think that's for the weekly chart. Going to the daily chart, as you can see, the same thing has happened. We have a high here in constant with the rejection block. We've attacked it right there. You can see the price has formed equal highs with the rejection block, and then Thursday we attacked it. You can see Friday is just being inside the range. Basically, this week I didn't do any trading because I believe on Thursday we had a holiday, 23rd of November, I believe. It was the Thanksgiving. So due to that and due to my rules, the rules of my playbook is that I don't trade the day before the holiday and the day after the holiday. So I wasn't able to trade Wednesday nor Friday. And of course not Thursday because it's the holiday. So the 3 days I could the last 3 days I couldn't be part of them. Monday and Tuesday I I took a position in London. I'm gonna make sure to include it in the description to show you. As you can see here, between Monday and Wednesday, there's the immediate rebalance algorithmic signature in price, where price is just gonna be dropping lower, touching the high of this candle, and then running up higher. And you can see that Monday has formed a high, Tuesday running up higher, Wednesday it has retraced to the high of Monday's high, and then it has rallied up higher from there. So this is kind of giving me, or like it's kind of telling me that we're likely to see higher prices attacking the buy side liquidity here and the buy side liquidity here. That's gonna be pretty much it for ES. Going to NQ. Here we're viewing the continuous contract. I'm also viewing the monthly chart or the monthly time frame. For the lazy people who are viewing my channel, I've called out that we have a monthly breaker high and monthly breaker low, and I've mentioned it and I've showed it in one of the weekly reviews back in the past. But now I'm viewing it again to show you the significance of it being on my chart. We have this candle, down close candle. This is the monthly breaker high. This is the monthly breaker where we have a high, low, higher high, and then we broke lower. This is the breaker. You can see that we tested it here and we traded lower to this fair value gap. So it's kind of like we walked inside the external range of liquidity, which is the breaker, and then we walked inside the internal range of liquidity. And now we're going back and attacking the external range of liquidity again. If you would calculate or measure the mean threshold of the breaker block, this bearish breaker block, you would see that we have closed above. I'm not going to be doing it here. You can go to your charts and you can do it yourself. We have closed above the mean threshold of the bearish breaker, this monthly bearish breaker. And if we do get this case, this is a lesson for you. If we touch a breaker, all right, and then if we trade away from it, and later on we come back and close, if it was a bearish breaker and we close above the mean threshold of it, this is telling me that we're likely to see it fail and it's going to be attacking the buy side liquidity here, this buy side liquidity, and this buy side liquidity right there. So I'm expecting now, since we have closed above the monthly bearish breaker mean threshold, I'm expecting price to continue trading up higher, attacking this buy side liquidity right there, this high, and this high right there. Listen carefully to what I'm saying, and just, it's not ambiguous. I'm literally sharing why I'm thinking price is gonna be attacking this high, why price is gonna be doing this and doing that. Going to the weekly time frame, as you can see, the same thing is just zoomed in. We have the buy side liquidities here that I've mentioned. It is the trend line phantom that you will be thinking about. Here you can see that we attacked the buy side liquidity here. Next week we traded lower, treated the high of this buy side liquidity as support, and then we rallied up higher. We took this buy side liquidity, and then the next week, which is last week, we traded lower, we traced to the high of this buy side liquidity, treated it as support, and then rallied up higher. But in this case, we didn't reach to this buy side liquidity, so that's what I'm expecting. Instead, we have formed a long premium wick. I'm measuring the wick consequent encroachment here of it. If we do close above the wick consequent encroachment of this premium wick, which is also this is the monthly break, the monthly fair value gap. This monthly fair value gap. So if we do close above it, it's also the consequent encroachment of the monthly fair value gap. So it's like treating it as, if we close above it on the daily time frame, we are likely to treat it as support that's going to be sending price higher. Otherwise, if we treat it as resistance on the daily time frame, we're likely to see a retracement towards this fair value gap before we continue running up higher, because we have a low, high, lower low, higher high. That's a bullish breaker right there. It's not mentioned here. I'm trying to make the charts clean. I'm not trying to include many annotations, but this is what is going inside my head. This is what is my inner musings that are going inside my head. We have a bullish breaker. Many things are influenced here. Many things are jumping on the charts, telling me that we're likely to see a strong support at this area right there. With the favor gap, the old high, the bullish breaker, everything basically. So as I mentioned on the daily time frame, if we treat it as resistance and we do not close above it, we're likely to see price to work inside the weekly fair value gap. If we do get a close on daily time frame above the wick consequent encroachment, I'm expecting price to continue running upward. This buy side liquidity, and the monthly breaker high. Going to the daily time frame, as you can see last week, I've mentioned that we have an external range liquidity. We've worked inside the internal range liquidity here. And I mentioned we're likely to see price to work inside the external range liquidity because we've already worked inside the internal range liquidity. The internal range liquidity would be this fair value gap right there. We worked inside of it last week, not the week before, the week before the last week. And then last week we have rallied up and took out the external range liquidity because we have accumulated positions as an institution order flow entry drill here in this internal range liquidity. So, and you can see that the wick consequent encroachment of the daily or the weekly time frame, which is right there, on the daily time frame, it is basically rejection block with the wick consequent encroachment of this, the wick consequent encroachment of this premium wick. So many influence of this level right there. If we do get a close above it, this is telling me that we're likely to see price continue running up higher, take out this buy side liquidity, and reach to the monthly breaker high as targeting objectives. We use BD arrays for entering purposes and targeting purposes, and the monthly breaker high can be used if we do get a close on the daily time frame above the week consequent encroachment. We can see price continue running up higher for the monthly breaker high as targeting purposes. So I think that's going to be pretty much it for NQ. Going to Dow, here we're viewing the the continuous contract, and we're viewing the weekly time frame or the weekly chart. As you can see, we have attacked the buy side liquidity here. We're very close from attacking this buy side liquidity. If we do good this buy side liquidity, we're aiming at these highs right there. We formed a fair value gap here in concert with the last week's trading. So as a result of last week's trading, we have formed this fair value gap. I've kept this bearish order block level because it can be used later as support. We can attack the buy side liquidity here and retrace and work inside the weekly fair value gap and treat the bearish order block, this bearish order block, as support, because we use the inversion level of these PD arrays before we really up here take this buy side liquidity. Going to the daily time frame, as you can see, we have the buy side liquidity here, buy side liquidity here. So now, if you would tell me how far can price reach to after it takes out this buy side liquidity, which you mentioned that it's very likely that we're gonna be attacking this buy side liquidity, which is the 35,500, which is this level right there. Above this level, we have a small fair value gap, as you can see, this fair value gap. You will be looking inside of it as if it's because of it's a small fair value gap. I'm looking basically at the high, consequent catchment, and the low. But if it was a big fair value gap, like right there, we have a high, this buy side liquidity, and how far can it go above it? We have this big fair value gap. This is not a small fair value gap when compared to this fair value gap, and we have this discount wick. So you could be looking at the consequent catchment of this fair value gap in concert with the low of this discount wick or this candle. There will be some influence here, and you can see how we run it up through it. But this is what I'm expecting. Price can now retrace. We have a bullish order block here, and we have a fair value gap. I tried to annotate it here. The black box shows the fair value gap, and we have the black line shows the bullish order block. So price can retrace before it attacks the buy side liquidity. It can have a short-term retracements on Monday and on Tuesday. So Monday, Tuesday, it can form down close candles. Tuesday can form the low of the week, and then we can rally up higher, take out this high. If it was really animated, it would just rally through this fair value gap and treat it as support and continue running up higher for this buy side liquidity and the rest of this buy side liquidity. So that's what I'm thinking, or that's why my inner thoughts about Dow. That's gonna be pretty much it for Dow. Going to Euro USD, also known as the fiber. Here we're viewing the weekly time frame or the weekly chart. As you can see, we've attacked the buy side liquidity that I've mentioned weeks ago. It is expected and logical to see price after attacking the external range liquidity to trade and work inside the internal range liquidity, which also has a bullish order block. So we can see price retracing and working inside the weekly fair value gap and the bullish order block before continuing running up higher towards this buy side liquidity and this buy side liquidity if it wants to. Going to the daily time frame. Last week I've mentioned that we have a buy side liquidity and how far up can price reach to above this buy side liquidity. I've draw your attention to this fair value gap here between this candle's high, this candle's low and this candle's high. We have a small fair value gap. I've mentioned that price, if it wants to reach above this buy side liquidity, well, it can reach to this fair value gap, and you can see how smoothly, perfectly. This is not random, by the way. For the folks that are watching me or trying to learn what I'm doing here, this is not random. Sellers didn't like decided to, oh, we want to move the tide and we want to just be sellers here. No, that's not the case here. It's very algorithmic, it's very programmed, it's scripted. So everything you see in the charts, it's scripted to the tick. Sometimes you get the human intervention that comes into place, that comes into the marketplace on a form of the high impact news drivers. So they're using the high impact news drivers as a smoke screen to actually engineer and manipulate the marketplace. And these high impact news drivers can be the NFP, non-farm payroll, FOMC interest rates announcements. We have Fed Chair Powell. They can be using this as to manipulate the marketplace. We also have CPI. They can also use CPI to manipulate. So there are many events that smart money or the market makers, the real market makers, the people who you don't see, you don't hear about them, you cannot get access to them. Those are the people who actually manipulate the marketplace and cause the most harm in the marketplace on these events. They will be using those events as a smokescreen to drive price where they want to drive it, to induce and just engineer more liquidity in the marketplace on a form of buy side liquidity, sell side liquidity, and fair value gaps that is going to be utilized for them to either accumulate positions or offset positions. So let's say right there when they drop below this low, they've accumulated long positions here on a form of the sell stops. The people who sold here, they're gonna buy those sell stops. And then when price rally up higher, we have a buy stops here, they will be selling to those buy stops. The same thing, trade it lower, take out this low, accumulate more buy stops. At the sell stops here, they're gonna buy them. And we have a fair value gap, bullish order block. Then it has rallied up higher. We have a high that's buy stops above this high. They're gonna be selling to those buy stops because there are willing buyers. The people who sold here, they have buy stops. They wanna like cover their shorts above this high if they were wrong, because they would think that this high and this high are resistance and they will be trusting it. They will put their buy stops, which is the stop loss, but for the shorting. So they're going to cover their shorts to buy. How are they gonna cover their shorts? By buying. And smart money who bought here, they're gonna sell to those people who are gonna buy here. So they are basically, there's this paradigm shift that my mentor has taught me. It is between the smart money and the retail or the large funds. Large funds have big funds that are resting above the highs, and those can be the long term. You can see them on the daily, such as this high has large funds buy stops. Maybe not retail buy stops, but for sure, large funds buy stops are going to be above this high. Retail stops are not really significant in terms of volume or in terms of liquidity when compared to large funds liquidity or large funds stops. So that's basically how I've explained earlier, how price just, it's like a constant war between retail, large funds, or and smart money or the market makers. There's always this battle. There's always this shenanigans that are happening between both of them. And you can see it in the charts clearly. If you have the eyes to see it, you can basically go and backtest it, and you can see it in your eyes that that's always the case. It's using what has been taught to us in the retail books, such as the Bible of, I'm not sure the technical analysis of the charts. I'm not sure which book is it, but it's by Morph. I believe it's the author name. So they're using this knowledge and using this information that it's in this book to actually engineer and accumulate positions. And that's a reason why more than 90% of people lose trading, because they're following the wrong scheme or they're following the wrong way to actually trading. Anyway, out of this, getting this out of the way, back to our topic, as I mentioned, we're basically here stuck between this high and this low. So we're inside the range, so this high and this low, Tuesday's high and Wednesday's low. You measure the consequent encroachment of Tuesday's premium wick, consequent encroachment of the premium wick, and you measure the consequent encroachment of the discount wick of Wednesday. You can see that this wick, which is this wick right there, is the same thing as this discount wick consequent encroachment. So we have an influence here. Price can be treating them as support because we have more levels converging or converging here at this level when compared to this consequent encroachment of Tuesday's high or Tuesday's premium wick. So if we treat the consequent encroachment as support, we're likely to see price trade lower, work inside the weekly value gap, take out this low, and basically accumulate more positions before running up higher. If we treat the consequent encroachment of Wednesday's low or Wednesday's discount wick as, oh, this one's resistance, excuse me. If we treat this as support, so again, if we treat the consequent encroachment of Tuesday's premium wick as resistance, we'll have to see price attack the sell side liquidity and accumulate more positions at the weekly fair value gap. If we trade below and treat the consequent encroachment of the discount wick of Wednesday, We like to see price attacking the buy side liquidity and reach for the higher objectives or the buy side liquidity objectives, draw liquidity that I'm looking for. And what I'm mentioning here is in terms of resistance of Tuesdays with consequent encroachment of the premium week and the support of Wednesdays, consequent encroachment of the discount week, is I want to see price close. If it wants to disrespect this, I need to see it close above it. If we close above it, it means that we like to see high prices. And if we close below this consequent encroachment of the discount week of Wednesday, we'll have to see lower prices. So that's how I'm measuring it. That's on the daily time frame, by the way. We get a daily closure above this high or above this one consequent encroachment, we'll have to see high prices. If we get a daily close below the consequent encroachment this Wednesday's discount week, we'll have to see lower prices. That's how I'm looking at it. It's not ambiguous. You can look, you can go to your charts and you can measure the highs. You can measure this with consequent encroachment and this with consequent encroachment, and you can see in your eyes if what I'm saying is true or not. But that's what I'm expecting. I honestly think if price on DXY, let's go back to DXY. If price would trade lower, trade the and close below the weak consequent encroachment, we like to see price on EURUSD screaming higher. But it's, it all comes down to DXY. If DXY wants to if it wants to run lower and disrespect the weak consequent encroachment of the discount week, we like to see price on EURUSD just screaming higher, using this as a bullish order block and just continuing up higher for this buy side liquidity. I think that's going to be pretty much it for Euro USD. Going to Pound USD, also known as the cable. Here we're viewing the weekly time frame. As you can see, last week we ran up higher, weekly heavily gap, we attacked it. We still have the weak consequent intact, price didn't reach to it yet. We did reach to the weekly inversion heavily gap here. As a result, we have formed a fair value gap here. I didn't draw it because uh, like approximately it is the same fair value gap as here. So if you draw this fair value gap from this candle's low from to this candle's high, it is basically very close from this candle's high to this candle's low. So there's very close levels. I think this level is a bit higher, but that's it. This would be like a balanced price range because we have a sell side delivery, buy side delivery. So price can use it as an institution order flow before it reaches up higher, attack the buy side liquidity, or it can just run and attack the buy side liquidity. It all comes down to what DXY is wanting to do. If we see price on DXY showing support at the wick consequent encroachment of discount wick, you can rewind the video and you can see it. We'll have to see price on Pound USD to trade lower, walk inside the weekly fair value gap. But if it was the case that DXY has just showed us the signature that it wants to trade lower, as I mentioned the signatures in the beginning of the video, this means that we'd like to see Pound USD and Euro USD and pretty much most of the majors that start with the foreign currency first and then the DUSD to rally up higher, just continue running up higher. We have buy side liquidity here, we have buy side liquidity here. That's what I'm looking at primarily. Going to the daily chart, you can see that we have attacked the buy side liquidity here, attacked the buy side liquidity here. We have the weak consequent encroachment, and we have the buy side liquidity here. We have a small favor gap here that I didn't draw your attention to, but you can look at it. We're very close from it actually. You can see that we have a bullish order block here that I've mentioned last week. Price retraced to it. You can see that the closing price wasn't below the mean threshold of this bullish order block. What does this tells you? This tells you that this is now a bullish propulsion block. This is taught to me by my mentor ICT. This is a very, very, very strong PD array. Price can just treat the high to the open to the high. This area right there, magic area, is very strong. So it's like a springboard. If it traded below and just touches it, it would be like an immediate rebalance and it would just rally up higher. And you can see that the high of the propulsion block is also the buy side liquidity, which is the high, old high. So we have many influence here on this high right there. If price wants to reach lower and we have the weekly fair value gap, it can be used as an inversion fair value gap. It would trade lower use them as inversion fair value gap, and then rally up higher to the wick constant encouragement, the buy side liquidity here. As I mentioned earlier, it all comes down to what DXY is wanting to do. If we get a signature that wants to trade lower, we'll have to see price to just continue running up higher on pound USD, Euro USD, and other markets. But if it was the other case when when DXY is wanting to trade higher, this means that we'll have to see pound, euro, and other asset classes to run lower, accumulating more positions below the old lows, book inside the fair value gap, and then later in the future it can run for the buy side liquidity objectives. I also want to state that we're entering the last month of the year. It is to be considered that it is more of a low probability, and you can see, uh, let's say on indices, it's basically been very stagnant. Like, sure, it moves to the upside, but this is not the condition that you want to be looking at. You can go to the lower time frame, 15 minutes or 1 hour, you can see that it's very choppy. Unless you know what you're doing, right, you will be chopped out very quickly here, and you'll just hate trading. You'll say that this is not for me, and you'll basically hate your trading progress or development. So it is advised that you take trading easy. Don't try to push the limits. Don't try to do home runs. Don't try to do any of that. Just take it easy, because the other, after every move, there's has to be the consolidation, which is going to be building the orders. It's going to be building the liquidity, and the runs are going to be coming back to the marketplace. So there's always going to be running in the market after the consolidation. We have been told this and we know this, that after consolidation, it is primarily to see consolidation. Price cannot just rally up higher or rally up, tank down lower all the time without going inside some kind of consolidation or a retracement. You can see that the price entered here, a consolidation, retracement to the fair value gap here, and then rally up higher. That's absolutely normal. You can see that bullish order block, price after rally up higher, took the buy side liquidity, retraced on this candle to the bullish order block, and then just continue rally up higher. Actually, I was part of these moves. I already have them on my Twitter. You can go and check them out. So just hold your guns, stand still, sit on the sidelines. You can utilize this time by referring back to old journals where you have done the right things, and you can reflect upon those journals. You can be learning more, backtesting, and utilizing this time for your own benefit, instead of just staying at the charts 24/7 and not knowing what to do specifically. So that's gonna be pretty much it for this weekly review. I hope you found it insightful. Until I talk to you next time, be safe. Wassalamu alaikum warahmatullahi ta'ala wa barakatuh.